Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, November 27th. Trump's tariff threats took a toll on car makers yesterday, but the news of a 60-day ceasefire between Israel and Hezbollah boosted the risk appetite at yesterday's trading session and pushed major US indices to fresh all-time high levels. Then crude oil fell and the US dollar retreated. Today, all eyes are on the US growth and inflation numbers. Even though Donald Trump's tariff threats on China, Mexico, and Canada didn't concern Europe directly, the feeling in Europe yesterday was far from being comfortable, I can tell you. Because the man, Donald Trump, is not yet in office and his plans are flying in the air already and are impacting the international relationships, international politics, geopolitics, and market prices. For Europe, particularly, the word tariff gives cold chills, especially to the European car makers that are already in the crossfire with China, remember, to which their politicians, so the European politicians, imposed tariffs as high as 45% this year. So the last thing that European car makers want to hear is the word tariff. Additional tariffs. It's not good, guys. As such, Stellantis lost more than 5% at yesterday's trading session, while the German Volkswagen tanked another 2.76%. Overall, Germany and Slovakia are the most vulnerable countries in the Eurozone to additional tariffs for Europe. Because half of Germany's GDP actually comes from its exports, and the car exports make up to around 15% of Germany's total exports. That was a number from 2023. And Slovakia, on the other hand, has the highest per capita car production globally, with automotive exports forming a significant part of its economy as a result of it. So these two economies are not in a good position. And well, for Germany, it looks like the economy curse seems unrelenting. The country, well, didn't have time to pull itself out of the energy crisis due to the war in Ukraine that the trade dispute with the US is about to hit. Now, funny enough, you wouldn't actually guess that the German economy is suffering big time right now when looking at the DAX valuations. Because the DAX index is trading near all-time high levels, whereas we all know that the underlying economic fundamentals in Germany are telling a whole different story. But this is how the market works. It is not always rational. In the US, the market move was better yesterday, really. Donald Trump's tariff threat, the rising inflation expectations for the US as a result of these tariffs, and the cautious approach for further interest rate cuts from the latest FOMC minutes that were released yesterday were not necessarily supportive. But the good news from the Middle East this time gave a smile to investors in the US and boosted the risk appetite there. Because unbelievable at this point, but true, Israel and Hezbollah inked a 60-day ceasefire agreement yesterday. Now, obviously, I'm a pessimistic person and I'm skeptical about the end of this war, but the news sure boosted appetite in the US stocks, as I said. The S&P 500 posted its 52nd record high this year. The Dow Jones also extended its rally to a fresh all-time high level. Well, not everyone was happy, obviously, because GM, for example, tanked 9% yesterday as a supply chain's heavy reliance on both sides of the US borders, both the Canada and to Mexico, will probably explode the production costs and weigh on the company's profits. There is your America first. Elsewhere, the energy companies had a moody session as well yesterday as crude oil consolidated and extended losses below the $70 per barrel level for the US crude on obviously these ceasefire news from the Middle East. Now note that the news that OPEC Plus is considering delaying the oil production restart beyond January has certainly tamed a part of the selling pressure due to the geopolitical relief. As key nations at OPEC, they actually said that the timing may not be a good one for pushing 180,000 more barrels in an oversupplied market. And the IEA in the US predicts an oil surplus of more than 1 million barrels per day next year And that's mainly due to the faltering Chinese demand. And well, that number actually risks being higher next year with Donald Trump's drill baby drill policy. Now, OPEC will be meeting at the start of next month at December 1st and should, in my opinion, well, drop its plans to provide more oil to the market in the next few months. And the latter should eventually help throw a floor under the oil sell-off, but will hardly reverse the medium-term bearish outlook for oil prices. Because only a significant jump in oil demand, especially from China, could do that. And as we all know, China is not delivering at this point. As such, the price rallies actually could remain capped into and above the $70 per barrel psychological resistance, and the 50-day moving average, which is just above that level, could eventually serve as an interesting top-selling opportunity for reinforcing the bearish positions for the medium run. In the FX, the US dollar actually eased at yesterday's trading session as investors priced out a part of the geopolitical risks in the Middle East, while appetite in gold remained intact. Then the US 2-year yield extended a retreat yesterday as the probability of a 25 base point cut from the Federal Reserve in the December meeting jumped to 65% in the aftermath of the release of the meeting minutes yesterday. So today, the US will release a bunch of economic data really before its Thanksgiving break. So on the menu du jour, we have the weekly jobless claims, we have the latest GDP update for the US, the durable goods orders, and the core PCE index, which is the Federal Reserve's favorite goat of inflation. Now, quickly looking at these numbers and expectations, the US economy is expected to have grown by around 2.8% in the third quarter. That's slightly down from the 3% printed previously. But sales in the third quarter are expected to print a strong 3% growth. That's something that we already saw. It's not a surprise. So price pressures are expected to have tamed in the third quarter, as we know as well, which is a good thing for the Federal Reserve, those, and for the rate cut expectations from the Fed. Yet, the core PCE index probably ticks higher to 2.8% in October from 2.7% printed a month earlier. And that is not good news for the inflation trajectory in the US. Even less so, as Donald Trump's tax cuts and additional tariffs, universal tariffs, are expected to give a certain boost to price pressures in the coming months. As such, a relatively strong growth number from the US and softening price pressures last quarter will obviously be very much welcome by investors, but strong sales growth and a potential uptick in core PCE demand quotient. I still believe that cutting the rates first and seeing what happens next is not necessarily the best strategy to adopt for the Fed when the economic data remains strong. But of course, I am not the Fed head. So the only thing I can do is to make educated guesses on what kind of market reaction we are going to see. So in that context, I believe that if the inflation data, the core PCE, doesn't surprise to the upside, what investors will continue to back the idea of another 25 base point cut in December from the Fed, and the latter could eventually lead to a further downside correction in the US dollar, and obviously a rebound in major currencies against the greenback. Because look, the Kiwi actually rallied today against the US dollar following a wildly expected 50 basis point cut from the Reserve Bank of New Zealand. So this cut marked the second consecutive 50 basis point cut in New Zealand, bringing the total rate reductions to 125 basis points in just over 3 months, making the Reserve Bank of New Zealand the most aggressive rate cutter of the year. But the RBNZ predicted that the average cash rate will fall to 3.83% by the middle of next year, suggesting that the policymakers there will move to a more gradual rate cutting path moving forward. So the latter could eventually open the door for dip buying opportunities in Kiwi after the currency dropped to the lowest levels in more than a year against a broadly purchased greenback. So for those who are not necessarily willing to take the risk of a further dollar appreciation with Trump, for example, and the Fed risk, well, shorting the euro, for example, against Kiwi could be an alternative play, provided the rising odds for more aggressive European Central Bank cuts under Donald Trump. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, even though it's Thanksgiving in the US. We will be working. So until then, good day trading.